Hi everyone, welcome back to my YouTube channel. So it has been a while that since we have talked about the US taxation. I was busy with some of the stuff related to my clients. There were some audits going on for the multiple states for few of my clients, and so till now many of the states I have completed the audit procedure, but still there are some going on. These are in progress, and hopefully I will make a separate video series on how to do the audit. When you receive the audit notice, what are the documents that you should have, that the states are gonna take, that the states are gonna check, and what are the red flags that uh, you should spot check when you are doing any uh, returns filing, and what are the those red flags that you should stop, you should avoid to do. But let's talk about those in an upcoming video series. But for now the topic is the three taxes every business in USA should know. How the taxes, which whether you are doing any sort of business, you should know. But before I move to the topic, I would again request all of you to do subscribe my channel and hit the bell icon to stay updated with the latest tax information. So there are three taxes which every business, if you are doing any sort of business in USA, you should be aware of. The first tax is the gross receipt tax. The second tax is the sales tax, and the third is the corporate income tax. Now, the first question that should be arising in your mind, that are these all are the same taxes? So the answer is no. We have talked about the sales tax in much detail, and in the upcoming videos we'll be talking about the income tax, the federal tax, the state tax. But for now, I will just give you a brief overview of all of these. So the first is gross receipt tax. Now the gross receipt tax, basically it's a tax that will be charged, that will be charged that will be charged on revenue. So it will not be charged on your profit, it will be charged on your revenue, not your profit. And there are seven states, currently there are seven states in US which are charging these gross receipt tax. And the states are basically, let me just tell you a few of them, like Washington, like Ohio, like Texas. So these are some states which are charging the gross receipt tax. Now the percentage is the flat percentage, so it could be let me just write it there, flat percentage, flat percentage. Now it could be 1%, it could be 2%, but normally it is between 0 to 3.3 percentage. So by zero I mean not by zero, but I would rather say 0 point, 0.1 or 0.4, 0.47. Like, let's take the example of Washington. If you recall, when we are talking about how to file the Washington state sales tax return, there is a tax which is called business and occupation tax, B&O tax. Now this is the tax that is charged on your total sales, the total revenue. And the percentage for the Washington, the percentage is 0.471 percentage to 3.3 percentage, depends on the business classification, depends on the income thresholds and thresholds of your sales, and it varies from state to state, but normally this is the percentage of this gross receipt tax. The important thing to note here is always remember that gross receipt tax is going to be charged on your total sales. Remember, when I'm talking about total sales, it includes all sales. So what I mean here is it includes your taxable sales as well, it includes your non-taxable sales as well. So if you at some point of time, if at any point of time you are filing your return and you are charging the gross receipt tax only to your taxable sales, the department or the state will reach out to you to get the extra tax which you haven't paid on your non-taxable sales. So this is also one of the red flag, that you must ensure that you are not gonna do that in your return. Gross receipt tax is a tax that will be charged on the total sales, not only on your taxable sales. It will be charged both on your taxable and your non-taxable sales is as well. And currently there are 7 states. Now coming back to the second tax, which is sales tax. We have discussed a lot on the sales tax. We have discussed about different states filing methods, and obviously I'll be doing the audit series on the separate videos. But for now, sales tax is a tax that is basically charged on the goods and also on the services as well, and it depends on the state rules. So in which state you are doing the business. So it is collected from the customers, and then the customers, it will be collected from the customers and then will be paid out to government. This is indirect tax basically. As we know that indirect tax is a tax that you pay to the government, but actually you are collecting it from the customers. And by customers, again, remember here the one of the very important point to understand here is the customer mean the end consumer. The person who is going to use at the end will be paying this sales tax. Now, uh, obviously there are some factors for the sales tax, like I always emphasize on the nexus is the basic rule, and it could be physical, it could be the physical, or it could be the economical nexus as well. Economical nexus. So it could be both, it could be single, and it could be a combination of both, and it again depends on different states rules and thresholds. So currently there are 5 states in US, 5 states in US which don't have the which don't have the sales tax, and they are basically Alaska. One of them is Alaska, the other one is the, I think it's Orange, and the other one is the New Hampshire. Now these are some states, there are 5 states. So these are some states which don't have the sales tax. Now remember, for one thing what I'm going to tell you here, Alaska is a state where there's no state sales tax. But remember, there are some counties which have the there are some counties in Alaska where there is a tax percentage, and if you are doing a business, if you have the sales in that county, you are going to pay the sales tax to those counties. But in the state wise, there is no tax in Alaska state. So sales tax, so there are 5 states. So sales tax is a tax that every business, if you are doing a business in US, you should be aware of sales tax. Now one thing, uh, let me just uh, add this point as well. Now here, thus remember one thing, sales tax will always be charged only on your taxable sales, not on your non-taxable sales. The tax will be charged on your taxable sales, not on your non-taxable sales. So if you have a sales of $1,000 and their $500 is the taxable sales and $500 is the non-taxable sales, so you are only gonna pay the sales tax on your taxable sales. But remember one thing, you have to report both sales. So reporting, you must be going to the state, wherever the sales, in whichever state you are doing the business and sales are happening. You're just gonna go to the state website. You have to file the return. In the return, you will report both sales, the taxable sales and the non-taxable sales as well. But the percentage of sales tax that you will be applying on your sales will be only to the taxable sales. And if you wanna see these more scenarios, you can just go and see my videos related to the sales tax. Now the next tax is corporate income tax. Now this tax is a very different tax from both of these tax. Why? Because this is charged on on profit, not on the sales directly. It is charged on the profit. So what I mean by here is, so for example, if you are doing a business and your total revenue, say for example you have a total revenue of $1,000, and then you have some expenses. Let's say for example you have some expenses of, let's say you have expenses of $200, then you have some deductions as well. Now what is the concept of deduction? I will explain later when we'll be talking about the federal and income tax, because it's a very long topic. And basically deductions, there are some deductions which are standard deductions, then there are some deductions which are itemized deduction. So I will cover these topics in a upcoming video series where we will be talking about the income tax methods. So let's say the total deduction is 200. Now if you subtract this from this and then this, so now this will be the amount where the corporate income tax will be charged. So remember, corporate income tax, now this is the tax where the state is going to charge you the corporate income tax. So this will be charged on the profit. Now the question is, for example, if I have a loss, then the answer is you are not going to be charged corporate income tax because you don't have the profit. The scenario, the criteria is that if you have a profit, you'll be charged corporate income tax. But if you don't have the profit, you are not going to be charged the corporate income tax. Now if I talk about that corporate income tax percentage and how the mechanism and the system that they are going to charge you, now there are two levels basically. The one is the federal level, you will be charged at the federal level, and then there will state level as well. So there are some states, in fact majority of the states have the state tax. So if you are doing in business on those states like Alabama, so if you are doing any business in Alabama, the first tax will be the federal tax, and other tax will be the Alabama tax, the state tax. Now each state has a different percentage. Again, it's a long topic, and it depends on the thresholds, the business classification. And so for example, now if there's a question arises that, for example, if a business operates in a multiple states, say for example if I have a business which is operating on multiple levels on a multiple states, so then which state you're going to pay? The answer is that it will be apportioned according to the sales. Now we will cover these topics in detail when we be talking about the corporate income tax, but for now, the corporate income tax is a tax that you're going to pay on your profit, the net profit. Now currently there are 44 states in US which has the corporate income tax, and the percentage is from 1% to 11%. This is the range that the states, the federal and the state charges. So 44 states in the US are the states where there's a corporate income tax. States, again I'm talking about the states. The federal income tax is a separate. You'll be paying the federal level and you'll be paying the state level as well. So these are three taxes which every business, if you're operating in US and if you have business in US, you should be knowing. The first is the gross receipt tax, which is going to be charged on your revenue. The second one is the sales tax, which is again going to be charged on your revenue but on your taxable revenue, taxable sales. And the third one is the corporate income tax, which you are going to be charged on your profit, not on your revenue. I hope this video is informative for you. If you have any questions, any comments, any suggestions, do let me know in the comment box. Thank you very much.